Hi everyone, today we're going to do a co-working feasibility study for a 1500 square meter or 16,000 square foot, depending on where you are in the world, co-working floor plan across one floor. And we're going to go through the revenue breakdowns, the cost considerations, what's fixed and what's not, depending on if you're watching this and you're trying to figure out a different sized co-working business case, can definitely help you with that. And if this is one of the first videos you're watching with me, my name's Tashi Dorji. My day job, I lead a co-working and flex business for a Fortune 200 business, Fortune 200 company globally. I've done about 547 of these feasibility studies for commercial landlords and investors and even entrepreneurs trying to set up their own business. And I design, build and operate them around the world. So I've got the scar tissue to give you this advice. And we're currently running like 15 of these around the world, branded whatever the client wants to brand it, so they're not branded under my name. Now, I've got my laptop here in front of me because I'm going to go through a simplified dashboard of numbers whilst I go through this, but I think it's important to go through the theory first. So let's get started. Like, what I'd like to do is, first of all, I've got a square here showing what the floor could look like, and you'll see there's already the lift entrance drawn in with arrows coming in. The product mix generally, if you want a commercially viable co-working plan, I'd say about 60% of that is at least going to be allocated to commercial product offerings, meaning the stuff that you can sell and book. And most of them are going to be the private office desks and a little bit of open plan desks. But we won't get ahead of ourselves and kind of talk through how many of them yet just for this floor plan. We'll get that in a second. It's more how you should think about your floor plate in general. I really think it's important to speak to someone within the business or a designer to figure out what the flow needs to be. But very basic principles, if we assume you've got natural light, so your best natural light is coming from the top and you don't really have much coming from the sides, you really want to prioritize that top part, not necessarily for a community amenity. These will be like your office desks, right? It's almost like generally you want to wrap the whole facade with those private offices because they're the most reliable source of income, which we'll get to, that's going to underpin your business case. The welcome experience, like let's say the remaining 40% of that NLA, realistically that remaining 40%, like 20 to 25% of that is circulation, fit out buffer, meaning when you build stuff, you don't want it to open the door and hit something, so you lose a bunch of space there. And your facilities, all that kind of stuff. So you don't really have a lot of space to be thoughtful and intentional about what kind of amenities you want to put in there. So that's really important. You really need to think about that. But obviously the welcome area is where you want to have a really thoughtful concierge. For this particular site, I've costed 2 full-time staff, 2 FT, which we'll get to. They're hybrid roles because for a site that's only 1,500 or 16,000 square feet, you don't want any more than 2 people. It'll get too expensive. So you've got a concierge there. I think, some staple amenities generally is you want a clubhouse lounge area, somewhere for informal meetings and sit down spaces. There's some really good informal meeting space cubicles where people can kind of sit and have a meeting, but it's not meant to be hyper secure. So it helps activate the space. And then that helps because if you're thinking about selling memberships beyond just the desks, you need to have a communal area where those members can just drop in, right? And feel like they're getting their bang for buck aside from the address that they're registering and the virtual services and all that kind of stuff. You might have a work cafe in there, but again, and I've got videos on this, don't expect margin or profit out of it. It's really there just to elevate the experience of your space. It comes with a lot of headaches. And then with a 1,500 square meter space, I really think, and I'm just circling around this front area because this is where you need to be intentional with your amenity. You could actually, arguably take some of that facade space for non-offices. And this really comes to when you get to a more detailed design and layout, you can start playing Tetris and moving things around. But for a pre-feasibility study, try and reserve that for the commercial stuff. Is what are you going to put in there that is different from every other co-working offering in the area? So I'm assuming you're watching this video because you've got an idea that you want to set up a business and you may have a building or an area that you want to do it. First thing you should do is almost look at all the competitors in the area And there's two things that you should take stock of. One, what amenities do they put in there? Like, of course, they've got the clubhouse lounge area. They may have event spaces, blah, blah, blah. But what do they don't have? Think about putting that in there. Like podcast studios, media studios, they're pretty staple now. But if there isn't one in your area, I actually think content creation is industry agnostic. Every business within your co-working space could use that, and then it could be one of your differentiators. Stuff that I'm seeing pop up in Australia and Asia a lot are like tech-free zones, library spaces that are related to wellness. So think about that. Additionally, when you look at your competitors, I really want you to look at their occupancy, and we'll get into that shortly on the right-hand side, the revenue stuff. But before we even get there, when you're thinking about just how much space you want to take, we're talking about 1,500 square meters or 16,000 square feet now, which I think is an appetizingly good size space for good economies of scale, but not too big. But what are their occupancies? Your competitors, right? If they're struggling to hit 80% occupancy, you really need to look into, okay, what makes you think that you're going to hit 80 to 100% occupancy in your site? Or even if they are hitting 80 to 100% occupancy, if you could do some extra due diligence to figure out if they're actually doing heavy discounts to hit those occupancy rates, that's important, because they may seem full, but they may be under budget because they're giving stuff out for free, which is a very common pitfall in co-working, and a big reason why some of the larger operators are handing back spaces and failing. So that's the floor plan, very high level, because I want to keep this video concise and cover everything for you. Building stacking plan, where should this floor go? Honestly, it can go anywhere, but I wouldn't take the top two floors, right? And we're just assuming this is what, a ground floor, 1, 2, 3, 4, 5 floor building. Generally, a lot of the co-working and the flex spaces I've looked at for larger landlords, they're very large assets. So think of 20 plus floor assets where the co-working space may take less than 10% of that building. But I do appreciate, especially when I've looked at feasibilities in the US, Canada, India, Texas, they're smaller buildings. Try not to go for the top ones, because the opportunity cost for that landlord is at that very high rent. So that's going to get pushed onto you as your business. And then that high rent means that you're going to have to do very expensive desks and offices. And you just have to ask yourself, is there a market for that? You can't just assume that everything gets more expensive because you're paying higher rent. So I generally stay away from the top floors, even if you've got beautiful views and stuff like that. Try not to. Doesn't mean you can't. Just shy away from it if I've got a bit of a choice. The lower floors are always nice, because when you think about it, it's easier for your customers to get to. But frankly, as long as you've got decent natural light, views are great, but not required. Just take what you can get, really. Like, at the end of the day, the opportunity that you're looking for, very likely you can't pick the floor that you want. It's going to be a vacancy that is serendipitous and presents itself to you, and you might get a good deal. So what I'm trying to say is, as long as it makes sense, the area, and you've got a decent floor plate to play with, I wouldn't worry too much about where it is in the building. Okay? There's a profit box down here we'll get to shortly. That was my attempt of drawing some trees to make the building look nicer. But let's talk about revenue products now, okay? Sorry we had to take so long to get to that. I just wanted to cover some of the basics over there. I'm going to be looking over to my laptop every now and then, because I've got my model here, which I'm pretty sure I'll have up on the screen right now for you anyway. But I've got some assumptions that I want to pull over here so I can explain it. So what do we have here? We've got 1, 2, 3, 4, 5. I would say there are 5 key channels of revenue for a traditional co-working space, especially if you're looking to set one up yourself and you're not trying to reinvent the wheel. The first one is office desks. Great. How do we get to how many office desks actually fit within a 1,500 square meter floor plate or 16,000 square feet? I use a desk density ratio of 7 square meters or 75 square feet per workstation, okay? That basically accommodates, your concierge, your amenities, your circulation, your facilities, your meeting rooms, all that kind of stuff. It assumes that's in that total 1,500 square meters. And then when you divide it by that, that helps you understand how many workstations you can fit after all those necessary products are assumed to be in that plan. You can actually go a lot less. So if anyone is watching in Asia, India, Singapore, Hong Kong, I've done feasibilities and jobs where it goes down as low as 5 square meters, or 55 square feet, whatever that equivalent is, because it's just a different market and a different culture. It's way more packed in there, right? Especially in India. Everything here is market sensitive. Like the methodology and what I'm explaining here is the foundation of how you should approach the business, right? But of course, there's going to be certain assumptions, especially when you get to the dollars and densities that are specific to your market. So that's when I can really help you if you want to reach out to me directly, because I've done this in essentially every market where flex and co-working is being considered right now. So if we use that density ratio from the 1500, you get about 214 workstations in total. And I like to split that according to a 85 to 15% ratio percentage. So that means if I do that, you've got 181 office desks and you've got 33 open plan dedicated desks. I'll just write that in here. And that's important because the office desks are your bread and butter for any co-working or flex space business for 2 reasons. One, they go for a premium because it offers security, it offers, flexibility so that that customer doesn't need to go rent a longer term space in a traditional office environment. They're also more expensive to build, which we'll get to that when you actually do your build and your fit out. But they're also sold on 6 to 12 month cadences, if not longer. So when you think about that, if you're running this business, that's a very reliable source of income, especially because deals are going north of a year or 2 these days, as long as escalations are built into those assumptions, right? Open plan desks, they're generally sold month to month or packaged in with the office desks. So someone might buy a 20-person office but want access to certain open plan desks. So they're not as reliable, which is why there's a less amount. And also they're sold cheaper, and we'll get into rates shortly. But I like them because they help the floor plan breathe. So if we jump here, the facade going around all offices, if you go around the whole thing, kind of makes it feel like an ant farm, right? Especially if you wrap some offices on the inside because of the floor plates, you end up having like 2 rows of offices with circulation in the middle. The open plan desks might be really nice to put somewhere operationally that makes sense near the concierge so that they can keep an eye on who's using it if it's people just walking in for the day, to help break up that NLA a bit, the desks. So you might put them here or something. Again, it really depends. It's case by case, because then as human beings in general, you don't want to just look at offices. It might allow more natural light to come in through that area, right? Because you've just got desks and not all these partitions and everything, even though they're glass and it lets a certain amount of natural light through. But it really, I feel like they could intentionally be used to make the floor plan breathe and the illusion of making certain spaces bigger, right? Because then if suddenly, and I know this is getting messy, but if this whole area, the concierge, the lounge space, you've got some meeting rooms, and then you've got the open plan desks opening up into a facade area, it almost feels like that whole area becomes one big communal space, right? Which is great, because then if you leave your office and you come into that area, it feels like you're getting a bit of an experience. So what does that mean in terms, before we go into meeting rooms, how we treat it from a pricing perspective? For the spreadsheet that I'm going to show you shortly, we've assumed that there's about, we're selling this in this current market at $900. A desk for the office desks, and $550 for the open plan. So you can see the price difference. However, when it comes to office desks, especially when you ramp up and sell them in the first year of running that co-working business, and by ramp up, let's say occupancy, you start at 30% and you want to hit 85% occupancy in a 12-month period, which is achievable for a 1,500 square meter site, you need to apply discounts, right? So that means in year 1, I'd apply probably a 25% discount to the $900 per desk listed rate, which comes to about $675 with the 25% discount. And then in year 2, you can go a bit cheaper, like 10-15% discount rate, which turns into $765. Sorry, this is becoming really messy. I should have made these squares bigger. Open desks, you don't really need to put discounts in because you've only got 33. There'll be a supply and demand dynamic happening there. So you can keep it at the 550. And in terms of occupancy, I think a lot of people should at least be modeling it at 100% because in theory you could oversell them, right? They're dedicated workstations that someone may sit, but because they're almost treated a bit like a gym membership in terms of usage, you could almost sell more than 33 desks worth, if you know what I'm saying. But I'm not saying forecast that, just forecast 100%, and maybe it takes 12 months to do that as well. Now, meeting rooms, okay, meeting room theory is really important. So the number of products that I've assumed meeting room wise for a 1500 square meter space in this is 5. Right, and generally I like to have one of each type of meeting room. And I've already been shooting for 15 minutes, so I'm not going to do this under 20 minutes. I need to get better at this. So there's one large boardroom, like 10 to 12p, depending on the demand that you do your due diligence on. Maybe 1 6 to 8 person, 2 4Ps, and like a podcast studio, like that arrangement, at least one of each. And within the floor plan, you'll have like phone booths and informal meeting places that can be used freely as well. Now, the important thing with meeting rooms in terms of their utilization rate, you calculate like how many hours they're available throughout the week when you take away public holidays and you don't count the really, awkward hours like 6 p.m. and that kind of stuff, or 7 a.m. And I like to assume a 20 to 25% utilization rate, which some may think is, low, but it's actually quite high. I wouldn't go any north more than 25%, even though we've achieved higher than that in certain spaces we operate. But that's also because you're not just selling within your co-working members, you're marketing it externally for people to come into the space and book those meeting rooms too. Or you're in a big building and you're marketing it to the rest of the tenants, okay? The reason why the 20-25%, I had the rubber on just then, the 20-25% makes sense is because let's say you're going to give a few hours for free or a certain amount of hours per desk you sell away for free to that user. 30% of the 100% is gone. And then you accommodate turnover time or the really early mornings or late evenings where it doesn't really get booked, or days after public holidays, you kind of lose those hours too. So I feel 20-25% is pretty bang on. In terms of the rates, you need to do your own market due diligence on what meeting rooms go for in that area and just try and, be amenable with that rate. The event space, I always like to assume that there's one in there, and this doesn't necessarily have to be a dedicated event space because that'll take up space within your NLA, and you may decide that you don't want to allocate that space because it doesn't really make a lot of money, if I'm going to be honest. It's more of an amenity box that you need to tick if people want to use that within your co-working environment. I do think there's an opportunity to make a lot of money out of event spaces, but you'd almost need someone allocated in your team or as part of their core KPI and job description to sell it. Like if you look at the hotel industry, they have conferencing and events teams dedicated to selling those types of spaces. You can't just assume your center manager or your community manager can do it. So in terms of your utilization rate, your occupancy, I only assume it's going to be used 10 to 15% of the time. And much of the time more recently, rather than having a dedicated event space in there that could sit dead when it's not being used, even if you try and make it multi-purpose, I like to almost have it an informal event space. So that whole area that we were going over with the concierge, the open desks, the lounge area, if you design that correctly, that could double up as an event area for informal, non-sensitive events. So if they're just celebrating, someone's work anniversary or a deal that they've won and they want to book that space out because they like your co-working space and they don't really need to go gangbusters somewhere else, you just organize some catering and use that general area and member etiquette, you let everyone know, you can book that out, right? So that's something that you could think about. Now, ancillary revenue, this could be everything and anything that isn't your core, your other four, okay? And this is generally a target that you set. So this could be selling, virtual services, selling your address to be registered for small businesses in the area. It could be the flexible memberships that you sell that aren't a dedicated open plan desk or office desk. It's all of that stuff. It could even be sponsorships. When you think about, okay, if we've got 214 workstations worth of members to sell, those are very sticky eyeballs that you've got because they're working within your space. Are there any local brands that want to get in front of them, whether it's software as a service or physical products? That's stuff that you could advertise as long as you don't push it within your newsletter or within your space. There's all that kind of stuff. So we've set a target within this assumption of about 8K. And the total of all the revenue, if I have a look at this, and we'll look at year 2, because that's after your ramp up, right? Is close to $2 million. So it's 1.9 mil. It adds up. It all adds up. But majority of that, as you can see from the dashboard, is coming from your private office desks, right? And the good news is that's reliable because you're selling it 6 to 12 months at a time. There's going to be periods of times where you go, oh man, right? We've got 20% potentially coming up for renewal. We really need to make sure that they stay. We don't want to deal with that gap in our cash flow. But that's the whole business. That's the ups and downs that comes with running with a co-working space, which is why retention is really important. It's not just about the desks. It's like, what can you do to make people feel like they're part of a community or have experiences? How do you budget even for activation events within your space? Which is actually a really nice segue into costs, right? And there's 5 key, well, I'll put CapEx as a question mark for now. There's 4 key cost groups that you need to think about, okay? The first one is your property costs, and this is kind of like your cleaning, your utilities, your repair and maintenance. It's all the building stuff, okay? And I'll actually just grab it out of what this looks like in year 2 because I want to talk about if they're fixed or variable. So in this model, we've got it as about 101K. And I'm going to say this is variable because it's allocated to a square meter or a square feet rate. Right, that 101K is going to go up if the space goes up, goes down if it goes down, because you're literally paying for the property costs of the space. Now, this isn't building outgoings or triple N costs. That's different, which we'll get to. This is actually the cost to deal with your space and not the communal spaces of the building. Now, you've got your operational costs, which we've got as about 190K here. And this is a sample. Right, so don't pull these numbers and think you can use it for your business, even if it's 1,500 square meters within the Asia Pac or Australia market. This is just to help explain how a business like this could be run. You really need to break these down and figure out what you need, right? That's the level of detail we go. This dashboard is very high level. There's probably about a detailed model behind this, which has, especially for the costs, revenue aside and all those formulas and everything, really thoughtful line items for everything that you need or you don't need, okay? So your operational costs, this is your activation budget. What are you doing for your members? This is your internet and your network and your security, how are you going to deliver your Wi-Fi, how are you going to have all that stuff within the space. It is your flex software and platform, right? Depending, especially when you start getting bigger at this size, you need a decent platform for billings and bookings, right? And those aren't super expensive, but they end up, good ones are like 3 to 5K a month, depending on your market, right? Especially for the larger sites. So that's all of that stuff. Is that variable or is that fixed? I would say it's kind of, it's half and half, but I would say it's fixed, right? Mostly fixed. Now your overheads, right? This is the most expensive one when you have a look at the model that I've got in, 447K. This bad boy is mostly fixed, and this is a conversation that we need to have. This is your on-site staff. This is your marketing budget, right? This is all those things which is really expensive when you think about it. And because I've costed in for 2 full-time staff for this place, that's a big reason why that annual cost is high. And marketing, it depends on how you want to approach it and your market, but generally 50 to 100K a year is what you need in terms of digital marketing and strategies to get your leads constantly coming in. Because it's not over once you fill it to 85% occupancy within the first year. You need to constantly keep that lead flow coming in so you can replace any members that potentially leave. Or you can strive for the 100% occupancy, because if you hit 100, even if 100% occupancy, even if it's only for a few months, it's not only does it feel great, but it really helps boost your cash flow up, right? Now, the reason why it's important to discuss why that's fixed is there's a certain size of space, if you're going to run a traditional co-working space like what we're discussing today, that you need to do so that you've got enough margin and there's good economies of scale, because that overheads cost is largely going to stay the same, right? So even if you go down to a 1,200 square meter site or a 1,000 square meter site, unless you deliver a different offering, your overheads are still going to be the same, which eats into your margin. Okay, but similarly, you could probably crawl up to a 2,000 square meter site and arguably potentially run it still with 2 people, right? You probably should do 3. But if your costs are largely staying fixed and the same, but you're selling more and more things, you can kind of see why co-working and flex space becomes quite a lucrative business the bigger you get, but then it becomes a game of greed. You know, there's a lot of businesses that went for a 3,000, 4,000 square meter space because the margins were euphoric. But because people aren't locked in long term, when COVID happens or when there's some sort of issue, like in the past, well, then you're not making really any money and you can barely cover your rent and your costs, and that's when you're in trouble, which is a big reason why many large brands that did the big co-working deals kind of went under, right, or got into big trouble. So I actually think the future of co-working and flex are these appetizingly smaller spaces of below 2,000 square meters. The last 3 deals I've done this year are all 1,400 to 1,500 square meter sites around Asia Pacific. Okay, outgoings and triple N, you know, we've got it here as about 140K. That's basically whatever the landlord property owner sets it at, because that's what it is. This one's important because, as you'll see in the dashboard, which I'm going to jump over shortly, so I'll pull the laptop over so I can explain it. You need to almost, when you have the conversation with the owner, just have it in the dashboard if you're pitching this to them, or if they're going to invest in the capital, or whoever you're speaking to, that's a cost that needs to almost come out before you start really looking into margin and everything like that, depending on the type of deal structure you look at. This is more for people wanting to explore a partnership or management agreement structure, okay? If you're just leasing the space and you want to run a co-working business and take the margin, less of an issue. Treat it almost like rent, okay? So another cost that should be written down there, sorry, is the rent, but that's assumed. CapEx, the question mark. The reason why I put it as a cost there, it's if you're watching this and you're more of an entrepreneur, and I know there's many of you out there thinking of co-working because it's a big part of the future of work and you want to set a business up, who's going to pay for the CapEx, the fit out of the space, right? Many of you who I've spoken to, you almost need to pitch even the landlord to pay for it, or you need to bring in another investor to pay for it because you're not fronting that capital yourself, which is why it's important to understand all of this in detail and pull together an investor-ready pack or white paper or deck. You know, unfortunately, I've done so many of these that I dream about them. I'm not even kidding. So I can help you with that as well. But the CapEx is important because there's different ways that you can treat CapEx. One is, do you, rather than just agree to the rent to the landlord, agree to a slightly higher one or some form of profit share so that they're slowly earning more than they would if they just traditionally leased it out to a normal tenant and not a co-working business, so they recoup that CapEx over a period of time and then some? Or do you actually amortize that capital like over maybe a 5-6 year period, and you include it as a cost line item from year 2 onwards, right? And maybe it's not guaranteed, but depending on a waterfall payment structure, after each of you earn the fee that you want as the operator, the rent that they want, and their outgoings, triple N paid, does the CapEx get filled? You know, there's different ways to approach it. And it's really important to have those conversations and explore it with your investor, because if you don't, ask yourself the question, unless you're really running a co-working space that is making a ridiculous amount of margin, how are they going to get their capital back within a 3 to 5 year period? Sometimes it's just like, you know, how you think about cost structures and how you break it up. So it's the illusion of them getting it back sooner than later, but they're not doing this deal with you for a short-term gain. This is like medium to long-term, right? Because co-working is here to stay. So what does the total cost look like for year 2? We'll do year 2 as well. After you accommodate all of that, we've got 1.45 mil. And this is all in AUD, by the way. I mean, again, the methodology is important, so it doesn't really matter. So what does that mean? That means in terms of profit completely left over afterwards, you've got about 536K profit in year 2, right? In year 3 and everything, it'll keep creeping more and more because year 2, you've hit your 85% occupancy. Oops, sorry. It's stabilized, and yeah, you'll have your escalations in there for your costs and your revenue. But that doesn't mean you're walking with 536K as the operator yourself. For this particular model, the reason why there is so much profit is because this is under a management agreement structure. So maybe what I'll do is I'm going to jump over from here to the dashboard so I can explain this a bit better, because this isn't your profit. Don't get too excited. Okay, so let me put this over here for now, and let me pull this bad boy over to me. So we've kind of gone through the revenue and the costs and everything like that. The reason, and we'll jump here, the reason why the profit, so I'll zoom in because you don't need to see all 5 years. The reason why the profit is 536K is because under this particular model, we're not doing it under a rent style arrangement, we're doing it under a management agreement partnership, okay? Meaning the landlord fronts the capital, you run the business, you agree on a fee that you take out based on a percentage of the revenue, but the landlord also wants to get a profit share so they actually make more money than if they traditionally rented it out to someone, okay? So that's why there's 536K left over, because the rent hurdle here is only been set to $250 per square meter. When the actual target gross rent, so the rent plus the outgoings for the landlord, is 640, okay? So instead of putting 640, well, not 640 because it includes the outgoings, instead of putting 550 there, under this arrangement we've agreed, let's put 250 in there, so at least you get, you know, a percentage, almost half of your rent early, and then the remainder you'll make up through some form of profit share mechanism, okay? Now, before the 536 profit is made as well, you as the operator in year 2 have taken out about 160K as a management fee, which is 8% of the flex revenue, okay? So that's why after you take out the rent hurdle, the flex revenue, you're left with 536, which is why then we start talking about profit share arrangements. The landlord gets 90% of the profit, you get 10% in this arrangement, so the landlord's walking away with 480K of that profit, you're walking away with 53K, but then what that means is the total income of the landlord is they take their outgoings, they take their rent equivalent hurdle, they take their profit share, they're netting about $1 million, right, income to the landlord, which when you equate in this Asia market, in Australia, to rent, they're earning about 664 bucks a square meter, which is $11 higher than the rent than they would have assumed, okay? Which is important. But then what that means for you as the operator is in year 2, you've made about 213K, which is not bad for a 1,500 square meter site. Unless you start really thinking about ancillary revenue and how you can do that, that's a very healthy number, especially at 85% occupancy for that size site. So start preparing yourself mentally for that kind of quantum for those types of spaces. Again, this is very conservative. So the desk pricing could go up, meeting room occupancy go up. You can kind of see the attractiveness for a co-working business as long as you're all over it, okay? And then for the landlord, right now, under this arrangement, they're getting a year 5 payback. So in this scenario, because it's a management agreement, they don't mind a slightly longer payback because they're doing this as a partnership, because that floor potentially was a bit troublesome to lease out, or they want to put this co-working space in the building because there's other tenants that have been asking for a co-working space, so this is their way of getting it. So this is why that partnership model works. However, if I was just to mess around with this really quickly, and change something in the model to 550. This is what it would look like if it was just a rent scenario for you, okay? The rent equivalent hurdle is now 550 set, so the rent's paid, profit left over is around 230K, which is your management fee as the operator. Okay, so I think I'll stop it there, and hopefully that was helpful. And I think next week I'll do one in a different market. So in the comments, please just chuck a market that you'd like me to have a look at. Again, the methodology is relatively the same, but it could be interesting to look at one in India where it's much denser and look at a particular type of floor plate. But I think just constantly doing different sized ones across different floors will be useful for you if you're watching all these different feasibility studies and if you're serious about doing co-working. So good luck to you. You got this. And if you want to have a further discussion, just hit me up in the link in the comments below, in the description below, sorry. I'll speak to you again soon.